For more on the latest market moves, let's welcome in here Michael Kantrowitz, Piper Sandler Chief Investment Strategist. Michael, always great to see you on the show. So when you're talking, Michael, to your clients, you use this phrase. You talk about, I think you say, narrative volatility. What do you mean by that, Michael? Walk us through it.
Yeah, it's a phrase that describes the consensus view on the outlook rapidly and in many cases completely shifting, doing a 180 from the prior conviction and outlook. We've seen this most in the bond market since 2023. Interest rates, if we look back 2 years, the 10-year yield is pretty much where it's been, but we've had these highs and lows over that 2-year period. While sentiment has swung from fear of inflation and more Fed hikes to fear of recession and a whole bunch of rate cuts. And we're kind of right now back in the middle of that range.
And you actually have a chart that illustrates this narrative volatility, and I want to put it up and ask for viewers' patience for a minute because it's a bit of a complicated chart, but effectively what it's looking at is the AAII. This is newsletter writers. And one of the things that folks like you and folks like us watch is sentiment among those newsletter writers. So this is just looking at bearish sentiment. The background here is the weekly reading. And then the white line is the 4-year rolling window, the standard deviation from that bearish, the bearish reading from AAII. And you've seen here that whipsaw effect that you talk about. But we're going to keep it up here for a second and explain to us what we're looking at.
Yeah, in the last several years, and certainly this year, there's been a lot of volatility in the markets from COVID to the inflation spike in 22 to the Fed tightening cycle and the uncertainty around that in 23 and 24. And then, of course, tariffs this year. So there's been a tremendous amount of volatility in sentiment alone. We've seen many periods just in the last 12 months where investors were really bullish and really bearish. And the flip-flopping is basically what is illustrated by that white line. How frequently is the data flip-flopping? And as you can see, we're at the highest levels in about 40 years. So that's one way to quantify narrative volatility. And I think it's a reflection of a very uncertain backdrop where so much is data dependent, whether it's what the Fed's going to do or how President Trump is going to react and set policy.
Do you think, speaking of Trump and policy, Michael, we did have another longtime market watcher like yourself on the program this week, and he was kind of arguing maybe we just sort of churn here. His argument was we can't move strongly higher until we get a trade deal. Not a trade handshake, a trade truce, a trade reprieve. We need a deal. What do you make of that argument?
I think a lot of risk around tariffs has already been priced out. I would say about 70% of the risk that was priced into the markets in March and early April has been priced out since the initial pause. And now we've had 4 pauses between Trump's initial pause, the pause on China, the pause on Europe, and then the courts essentially trying to pause tariffs as well. So there's been a string of good news, relatively speaking, on tariffs from where we were 6-8 weeks ago. That's why the markets are where they are. And I agree, going much higher from here, I'm not so sure how much a reduction in tariffs or deals necessarily, A, if they're going to actually even come in the near term, or B, how much more upside or relief the market has left to give. I think upside from here is going to be either if we see better economic data, we see softer inflation data, or we just grind along higher as earnings continue to grow, which is something we expect.
So if the risk continues to be that you'll see a whipsaw, right, do you try to position to catch the wave whichever way it's going? Or do you try to sort of average it all out and get sort of middle of the road returns that are taking less risk?
I'll give you a third option.
Okay.
You can take a balanced approach and actually get better returns with less risk. And that's, I would describe as been our quality preference for the last really 2 years now. We've been on this quality theme. And I think, again, that's a reflection of this uncertain backdrop, the bifurcation in the economy. We're clearly seeing, whether you want to talk about the difference between housing and AI at 2 extremes, or mega caps and small caps at 2 fundamental extremes. So that chart you had up before, the lighter line of bearish sentiment is extremely volatile, and catching the wave, good luck. Anyone who could catch that wave, more likely to be hit by the wave than catching it. So it's not really realistic to catch these short-term risk-on, risk-off swings in the market. And we think they will persist. And we think ultimately, while this volatility has persisted and will continue to, in terms of narratives and where things are going, that investors are going to continue to crowd into what has been a really good trade, these quality, highly profitable, strong free cash flow companies. So that quality trade.
Mike, I'm just curious, given that the big move we had off that April low and with the SPX right near record highs again here, how would you broadly characterize valuation?
Well, I would say it is expensive, i.e. it's high priced, but expensive doesn't always mean overvalued. You can go buy an expensive car and pay a fair price for it. You could buy a cheap car and get ripped off. So that's, I think, somewhat the case for a lot of growth and value stocks today. A lot of stocks, including the S&P index, is expensive for the right reasons. We've got near record high profit margins. We've got a market that is much more, or I should say, much less cyclical, much more asset light, so very different from 10, 20, 30, 40 years ago. And we have a backdrop where, yes, inflation is sticky and high price. We have high price levels, but oil is pretty low, certainly on a real basis. I'd say it's probably a 10, 20-year low on a real basis. So all of that put together should warrant a higher multiple for the market. The real concern here is not the multiple, but whether or not we get a risk that brings the multiple lower, i.e. another shock from tariffs, something that makes interest rates spike, or something that makes unemployment spike. Those are the three traditional catalysts: interest rates, employment, and something exogenous that lead to lower PEs from any levels.
Do you think that the sort of risk of higher interest rates, or at least a higher floor under interest rates as a result of this increasing drumbeat and concern over deficits and the debt in the U.S., is that going to be a sort of a more long-term risk for stocks?
I think it'll be a cyclical risk. We've been talking about the deficit, not we, but investors, that we have been worried about the deficit. I mean, going back to 2011. Yeah. But in the recent years, anytime interest rates are around 4.5 and higher, there seems to be a concern around the deficit. And it also tends to go away when interest rates come down. We've seen that the last few years. So I think it's going to be a cyclical risk. I don't think the deficit is actually driving up interest rates. I think it's data like we had today from JOLTS and the last two employment reports. It's just the economy's overall okay. We've got sticky inflation data. We've got a Fed that's kind of stuck. So we should have rates that are, I would say, roughly where they are. And I think they will go higher or lower, more dependent on where that data go from here. I can't think of a time where I could say, well, look, interest rates went up because of deficit fears. It's really hard to quantify, but I can quantify the data. And I think that's the bigger issue. Going forward over the long term, I don't think so. I think our economy is very reflexive. And we've seen the last few years, anytime rates get near 5%, you tend to get some short-term market downside volatility. You tend to see housing data, business sentiment, consumer sentiment roll over. And in a sense, that creates a reflexive softening of the outlook, which actually brings interest rates right back down. You also see the same thing when rates go down. You get a pickup in all that data, particularly in housing. It gets people excited. And so I think we are in a very reflexive backdrop where interest rates are stuck in this range of where we are now.
Gotcha. Kind of a best cure for high rates is high rates situation, and vice versa, I suppose. Mike, always great to see you. Thank you so much.
All right. You too, guys. Bye-bye.